Um, Welcome back to the deep dive. I want to start today by asking you to do something a little weird.
Okay, I'm intrigued.
I want you to close your eyes, assuming you weren't driving, obviously, and I want you to mentally transport yourself back in time. Let's go back about 10 or 12 years.
Right.
You're walking into a gas station convenience store. The fluorescent lights are doing that little humming thing. You walk over to the refrigerated beverage section, specifically the energy drink door. What do you see?
Oh, I can picture it vividly. It's an absolute assault on the senses. I see black cans with neon green claw marks.
Yeah.
I see these rigid industrial fonts that look like they were stamped onto a shipping crate. I see motocross bikes, flames, lightning bolts. The whole vibe is just screaming, I am extreme, I am adrenaline.
Exactly. It was aggressive. It was masculine in a very specific teenage boy kind of way. It smelled like taurine and sugar crashes. It was a product designed for the guy jumping a dirt bike over a canyon. Or at least the guy playing a video game about jumping a dirt bike over a canyon.
Right. It was fuel for chaos.
Now, snap back to the present. It's February 2026. You walk into that exact same gas station, or maybe you're in a high-end grocery store like a Whole Foods. You look at that same cooler door. The neon claws are still there, sure, but they've been pushed to the side.
Yeah, they've lost the prime real estate.
Taking up that space right at eye level is something completely different. It's sleek. It's minimalist. It's a tall, skinny white can with clean, modern typography. It doesn't talk about unleashing the beast. It talks about metabolism. It talks about fitness. It talks about essential energy.
It's a complete 180-degree shift. The category has gone from the skate park to the yoga studio and then straight into the boardroom.
It's not just for the adrenaline junkie anymore. It's for the spin instructor. It's for the coder pulling a double shift to ship a product. It's for the busy parent who just needs to survive the school run. And standing absolutely tall at the center of this massive cultural revolution is the company we are dissecting today, Celsius Holdings.
Ticker symbol CELH. And you are right to call it a revolution because Celsius isn't just a drink company anymore. They have successfully positioned themselves as what we call a lifestyle platform. And the numbers backing this shift, they are staggering.
They really are. But here is the tension, and this is exactly why we chose this topic for the deep dive today. We have a company with a 20% market share, over $5.2 billion in retail sales, and a growth story that has been practically vertical.
Vertical is the right word.
But they are currently colliding with some serious macroeconomic speed bumps. We are talking about the 50% aluminum tariffs that kicked in back in 2025. We're talking about a market that is getting incredibly crowded with copycats. And we're talking about a stock valuation that is let's just say it's pricing in absolute perfection.
It is the classic battle of growth versus gravity. The central question we need to answer today is this. Does this explosive growth story shatter under the weight of its own valuation and these external pressures? Or are we looking at the birth of the next enduring legacy brand? Like, is this the next Coke or Pepsi?
That is the mission. We're going to tear this apart bolt by bolt. And just to set our anchors, because this market moves incredibly fast, we're recording this analysis based on data from February 20, 2026. The share price is sitting at $43.43.
And the market cap is roughly $11.39 billion.
Exactly. And just to tease the conclusion a little bit early on, because I know people get anxious about where we're going with this, while that share price of $43 might seem sky high compared to traditional value metrics, a lot of Wall Street analysts are arguing there is still 50% upside from here.
The discrepancy between what the math says the company is worth and what the believers think it's worth is wider than the Grand Canyon right now.
Which is exactly where we like to live, right in that gap between the cold math and the big story. So let's get into the machinery of how this company actually works. Part 1, chapters 1 to 3, business, management, and financials.
Chapter 1, business understanding.
Okay, let's unpack the business model first. Because for a long time, Celsius was this scrappy underdog. They were the beverage equivalent of a garage band.
That's a great way to put it.
They were fighting for shelf space, one gym at a time, maybe getting into a vitamin shop here or a 7-Eleven there. But that version of the company is ancient history now.
Completely ancient history. The defining moment, the real inflection point that changed the trajectory of the entire enterprise was the master distribution agreement with PepsiCo.
Right.
This deal fully took effect starting in 2022 and has been ramping up straight through to where we are now in 2026, reaching full maturity.
We talk about distribution a lot on this show, and I know it can sound a bit dry, but in the beverage world, distribution is literally life or death. Explain why this Pepsi deal was such a massive game changer compared to what they were doing before.
So, before Pepsi, Celsius had to deal with a highly fragmented network of independent distributors. We call this the patchwork quilt problem in the industry.
A patchwork quilt.
Yeah, you might have one guy with a van covering 3 counties in Ohio and another separate distributor covering part of Florida, and then absolutely nobody covering North Dakota. It was incredibly messy. It was inefficient.
You're negotiating hundreds of separate little contracts.
Exactly. The logistics were a total nightmare. You're spending half your time just figuring out how to get the physical can to the store rather than focusing on selling the brand to the consumer.
And now?
Now they ride on the PepsiCo rails. We call it DSD, direct store delivery. This is the absolute gold standard in the beverage industry. It means a Pepsi truck pulls up to the grocery store or the gas station at 4 in the morning. A Pepsi employee, not a store clerk, but a dedicated Pepsi employee, physically takes the Celsius cans off the truck, walks them into the store, and packs them onto the shelf.
They're doing all the heavy lifting. Literally.
Literally and figuratively. This system has given Celsius a 99.5% all commodity volume penetration.
99.5% ACV.
Yes, which is a fancy industry way of saying if a store sells beverages, Celsius is in that store. They are ubiquitous.
That ACV number is wild. It basically
Right.
means you cannot miss them anywhere in the country. But it's not just about being inside the store, right? It's about where you're positioned in the store.
Yeah.
There is a massive difference between being tucked away in a dusty corner on the bottom shelf and being right in the consumer's face.
Correct. And this brings us to a term I absolutely love from their strategy. Celsius is now PepsiCo's strategic energy drink captain.
The captain. It sounds very authoritative. What does being the captain actually mean in practical retail terms?
It means they hold the pen. Being the captain means Celsius, in direct partnership with Pepsi, helps dictate the planograms.
And the planogram is
A planogram is the detailed visual diagram that tells a store manager exactly where to place each specific product on the shelf. Because Celsius is the captain for Pepsi's entire energy portfolio, they get to prioritize their own shelf placement.
so they aren't just crossing their fingers and hoping the store manager gives them the eye-level shelf. They are designing the map that assigns them the eye-level shelf.
Exactly.
Yeah.
They've moved from being a tenant in the building to being the architect of the building. They ensure they are placed next to the highest traffic zones, usually right next to the legacy power brands like Red Bull, specifically to encourage consumers to switch.
That is a staggering strategic advantage. But they aren't just selling that original slim can of Celsius anymore. The portfolio had exploded over the last few years. I feel like every time I look at a cooler, there's a new sub-brand or a new can shape.
That's the platform strategy in action. They realized early on they couldn't just be a one-trick pony. So you have the core Celsius line, which is the flagship we all know. Then you have Celsius Vibe, which is much more flavor-forward with distinct, bright branding. Then you have Celsius Essentials, which is the larger can size, the 16-ounce cans.
That was a direct shot at Monster, wasn't it?
Oh, absolutely. They needed a bigger can for the traditional energy consumer who thinks 12 ounces just isn't enough fluid for their money.
And they have the powders, too.
The on-the-go powders, yes. Very high margin, incredibly easy to ship. But the real seismic shift in the portfolio happened recently, right in that 2025-2026 window with their big M&A spree.
The mergers and acquisitions.
Right.
Like the buyout of Alani Nu, that was a huge headline.
Massive headline. It was a $1.65 billion net purchase.
Billion with a B.
Yes, that is a ton of capital. And for those who don't know, Alani Nu is a strictly female-focused wellness brand. It has a very specific aesthetic, pastel colors, very Instagram-friendly, heavily tied to wellness influencers.
But let me play devil's advocate here for a second. Celsius already appeals strongly to women. That was their whole original disruption point, right? Bringing female consumers into the energy drink category, which was traditionally dominated by men. So why spend nearly $2 billion on a brand that targets a demographic you already have? Isn't that just cannibalizing your own sales?
You might think so at first glance, but it's actually about incredibly precise market segmentation. Celsius covers the broad fitness enthusiast, that's male, female, the serious athlete, the casual weekend jogger. It's a broad net.
Okay.
Alani Nu locks down a very specific wellness lifestyle niche. It allows the company to own that female demographic completely without having to pinkwash the main Celsius brand, which might actually end up alienating the male consumers they're also trying to attract with the Essentials line.
Ah, I see. So Celsius stays gender neutral and athletic, while Alani Nu goes full lifestyle and aesthetic.
Exactly. It severely deepens their economic moat. And on top of that acquisition, Celsius is now actually managing the Rockstar brand for PepsiCo in the US and Canada.
That is such a fascinating dynamic to me. Pepsi outright owns Rockstar, but they basically handed the operational keys over to Celsius and said, you guys are better at selling energy drinks than we are. You run it.
It speaks volumes about the level of trust Pepsi has in Celsius's executive management. So now, look at the board Celsius controls. They have the hardcore fitness angle with the core brand. They have the aesthetic wellness enthusiast with Alani Nu. And with Rockstar, they maintain a grip on the legacy energy drinker, the blue-collar worker, the gamer, the traditionalist.
They are covering every single consumption occasion. The gym, the office, the party, the morning commute, and they are doing it without diluting the main Celsius brand name.
Precisely. It's masterfully segmented.
Let's circle back to that value proposition for a minute. You mentioned earlier the shift from extreme to clean. How did they actually pull that off? Because competing head-to-head with Red Bull and Monster seems like corporate suicide. Those brands are absolute marketing giants.
It's a textbook case of what business strategists call counter-positioning. If Red Bull is extreme energy, Celsius didn't try to be more extreme. They didn't sponsor bigger dirt bike jumps. They went the exact opposite way. They positioned themselves as a fitness partner.
Right.
Their marketing isn't about crashing a race car or jumping out of an airplane. It's about burning calories. It's about better-for-you ingredients.
The science angle is interesting here, too. They lean very heavily on the term thermogenic.
They do. They claim, and they have clinical studies to back it up, that the drink actually accelerates metabolism and burns calories. Now, does the average consumer walking into a 7-Eleven fully understand the biochemistry of thermogenesis? Probably not.
Almost certainly not.
But does it actually matter?
Not at all.
Exactly. What matters is the psychological permission it gives the consumer. It reframes the purchase. It's not a vice, it's a tool. If you drink a Monster, you might feel a little guilty about all that sugar and the artificial whatever. If you drink a Celsius, you feel like you are doing something proactive for your body. It allows them to capture women and health enthusiasts who would never, ever touch a traditional energy drink.
And the stats we pulled absolutely back that up. I'm looking at the data here. 37% of consumers report drinking it with meals. 33% drink it in social settings.
Yeah.
That is not how people consume Red Bull. You don't usually sit down to a nice dinner and crack open a Red Bull.
No, you drink a Red Bull to stay awake on a long midnight drive or to cram for a college exam. You drink a Celsius because it's integrated into your daily lifestyle routine, and that leads right into their moat. The real moat here is consumer habit.
Habit forming.
Very. At the Consumer Analyst Group of New York Conference, CAGNY, which just happened on February 19th, 2026, they revealed that 52% of their repeat consumers purchase 5 or more times.
Wow, 52%. That is incredibly sticky.
Massively. The global energy drink market is projected to hit $104 billion by 2030. So even being a strong number 3 in a $100 billion market is a highly lucrative, multi-billion-dollar position to be in.
Okay, so the business model is incredibly robust. They have the Pepsi distribution, they have the segmented products, and they have the psychological stickiness.
Right.
But a business model is really only as good as the people executing it. So let's look at the leadership.
Chapter 2. Management evaluation.
Leading the charge is the CEO, John Fieldly. He's really been the public face of this entire transformation.
He has. And honestly, you have to give credit where credit is due here. Taking Unleash fitness drink one that, fun fact, was actually delisted from the NASDAQ at one point in its early history, and steering it into an $11 billion enterprise is a Hall of Fame run for a CEO.
It's an incredible turnaround story. But management is ultimately judged on how they handle crises. And 2024 was a massive, massive test for this team.
You're talking about the inventory glut. That was a genuinely scary time for shareholders. The stock took a beating.
Walk us through exactly what happened there, because from the outside, it looked like the growth story had just died overnight.
So PepsiCo, their massive distribution partner, decided they needed to be more efficient with their own working capital. They slashed their inventory days across the board. They basically stopped ordering as much Celsius from the company because they wanted to run leaner warehouses. They felt they had too much stock just sitting around on pallets.
And when your main distributor suddenly stops ordering, your top-line revenue just drops off a cliff.
Exactly. The revenue growth numbers stalled. And the stock market absolutely crashed on the news because the immediate reaction was, uh-oh, the fad is over, the consumer has moved on, people aren't drinking it anymore.
But Fieldly and his executive team held incredibly firm during that period.
They did. They didn't panic. They kept going on earnings calls and telling investors, look at the scanner data. Look at the actual checkout lines in the grocery stores. The end consumer is still buying the drink at record levels. This drop in revenue is purely a supply chain reset between us and Pepsi.
Right.
They were completely vindicated. The 2025 revenue recovery proved that consumer demand never actually dipped. It was just a plumbing issue between the two massive corporations. And handling that the way they did builds a lot of credibility with institutional investors. It shows they understand the mechanics of their business better than the panic sellers do.
However, it is not all sunshine and roses with management. We have to address the SEC charge.
We do. This is definitely the primary friction point when evaluating their governance. On January 17, 2025, the SEC officially charged Celsius with reporting and accounting violations. These were related to stock-based compensation issues going back to 2021.
Now, when retail investors hear SEC charge, they tend to sweat. It sounds like Enron. What actually happened in the filings? Was there malicious fraud happening?
To be perfectly impartial based on the filings, no, it wasn't systemic fraud in the sense of faking sales or making up phantom revenue. It was a failure of internal accounting controls. They fundamentally messed up the accounting math on stock awards for departing employees and some retiring board members.
So an administrative failure.
Right. They settled with the SEC for $3 million. They paid the fine without formally admitting or denying guilt, which is standard practice in these settlements.
A $3 million fine for a company worth $11 billion feels like a total slap on the wrist.
Yeah.
But what does that actually signal to you as an analyst?
It's a red flag for corporate governance. It suggests that the back office accounting department maybe didn't scale nearly as fast as the front-end sales team.
Yeah.
When a company experiences hyper-growth like that, sometimes the administrative plumbing just breaks under the pressure.
Yeah.
And while the SEC fine was small, it triggered a wave of class action lawsuits from shareholders that are still lingering into 2026. So for an investor, it just means you have to scrutinize their 10K filings a little more closely than you might otherwise. It adds a slight governance discount to the stock's premium.
Fair enough. Let's pivot to how they spend their money. Capital allocation. We talked about the Alani Nu deal earlier, $1.65 billion net. That is a highly aggressive move.
Extremely aggressive. It shows they aren't content to just sit on their cash pile and play defense. They are actively buying market share. But the other major capital move was the share buyback program.
Right.
On November 10th, 2025, the board authorized a $300 million share repurchase program.
Now, typically, companies only buy back their own stock when management fundamentally believes the shares are cheap.
Exactly. By authorizing that buyback, management is effectively broadcasting to Wall Street. We know our internal numbers better than you do, and we think the open market has severely undervalued our future cash flows. It's a massive vote of confidence in their own trajectory.
But there is a specific metric in their financials that worries me, and it ties directly back to that Alani Nu acquisition. The ROIC, the return on invested capital. It used to be a beautiful number. It peaked over 22% in 2023. But looking at the February 2026 data, it has plummeted down to 2.6%. That is a staggering drop in efficiency.
It is a staggering drop, but we really need to contextualize the math behind it. This isn't necessarily a failure of their daily operations. It is a mechanical byproduct of the acquisition.
How so?
Well, ROIC is basically a fraction.
Okay.
How much operating profit do you generate for every dollar of capital you've invested in the business? When Celsius spent $1.65 billion in cash to buy Alani Nu, that invested capital denominator at the bottom of the fraction got incredibly huge, literally overnight.
So the denominator blew up.
Exactly. But the actual profits from Alani Nu take time to fully ramp up and integrate into Celsius's system. You have to realize the synergies, cut the redundant costs, all of that. So for a few quarters, the fraction looks terrible.
It's an optical issue right now.
Partly optical, partly a waiting game. Investors need to watch this metric like a hawk over the next 4 quarters. If that number stays stuck at 2.6% for 2 years, then yes, we have a massive problem. That would mean they fundamentally overpaid and wasted shareholder money. But if it steadily starts climbing back toward double digits as they integrate Alani Nu, then it was just a temporary, expected mathematical dip.
Okay, that makes perfect sense. Let's actually get into the rest of the hard numbers. Let's look at the financial scorecard.
Chapter 3. Financial health.
We mentioned the revenue roller coaster a couple of times. Let's put some concrete numbers on that trajectory so people understand the scale.
The historical trajectory is just wild. In 2020, their top-line growth was positive 55%. In 2021, it accelerated to positive 140%. Then in 2022 and 2023, they posted back-to-back years of over 100% growth.
That is software company growth. That is not beverage company growth.
Not at all. It's hypergrowth. But then they hit the 2024 wall.
Right, the supply chain reset with Pepsi we discussed.
Exactly. During that year, growth plummeted to just 2.8%. It practically flatlined.
But the rebound is what we're looking at now.
Yes. The trailing 12-month revenue, the TTM, for our February 2026 analysis is back up to $2.126 billion. That represents a 55% year-over-year recovery. The hypergrowth narrative is officially back on track.
What about profitability, though? Revenue is great, but are they actually making money on every single can they sell?
They are making very good money per unit. Their gross margins are incredibly healthy, sitting consistently between 50% and 52%.
So for every dollar of Celsius sold, they keep 50 cents right off the top.
Exactly. After paying for the raw aluminum, the ingredients, the manufacturing, they keep half. That is a tremendously strong gross margin profile for a consumer packaged goods company.
And what about operating margins? After you pay the marketing team and keep the lights on?
Operating margins are hovering between 17% and 22%. This metric is crucial because it shows that their operational leverage is actually working. Yes, they are spending an absolute fortune on marketing and sponsorships, but their sales revenue is growing faster than those underlying expenses.
But, and I'm looking at the sheet here, the net margins, the absolute bottom line, are shockingly slim. I'm seeing 1.1 to 1.5%.
Yes.
That seems incredibly low for a company with such great gross margins. Why is the bottom line so thin?
It's heavily weighed down by the immediate costs of the Alani Nu acquisition. You have integration expenses, legal fees, massive tax implications. Basically, management is heavily prioritizing market share expansion and top-line growth over maximizing bottom-line net income right now.
But there's a different metric that the true optimists on this stock absolutely love to point to, and that's the free cash flow.
Oh, this is the entire core of the bull thesis.
Yeah.
The trailing 12-month free cash flow is currently $523.6 million.
Over $500 million in pure cash generated in a year.
Correct. And you have to put that into context. Just back in 2021, this company was bleeding money. They had negative cash flow. This massive jump to $500 million positive proves that the underlying business model, once it reached this national scale, is essentially a machine that prints money. This is the exact cash pool they are using to fund the $300 million stock buyback and run the daily operations without having to take on dangerous high-interest debt.
Speaking of debt, let's look at the balance sheet. How leveraged are they?
The balance sheet is practically pristine. The debt-to-equity ratio is 29.4%, which is extremely conservative and healthy. In terms of liquidity, they're sitting on $806 million in pure cash and short-term investments.
So no worries about them missing a payment.
None. Their current ratio is 1.89. They can easily cover all their short-term liabilities almost twice over. They are financially bulletproof in terms of basic solvency.
So if we summarize the financials, we have phenomenal revenue growth, a massive cash flow engine, and a fortress balance sheet. But then we look at the actual price tag of the stock, the valuation.
Yes. This is what we call the priced for perfection problem.
Explain that.
Well, look at the PE ratio, the price to earnings multiple. It is currently trading between 347 times and 360 times earnings.
360 times earnings. Every time I hear that number, it feels like it has to be a typo.
It's not a typo. It is absolutely stratospheric. Just for some industry context, legacy beverage giants like Coca-Cola and Pepsi usually trade somewhere around 20 to 25 times earnings.
So if you're buying Celsius stock today, you are paying a massive historic premium.
You are paying strictly for the expectation that they will continue to grow at an extraordinary rate until their earnings catch up to that valuation. The market is pricing in the absolute certainty that Celsius will become a dominant global giant.
And if they don't,
If they stumble even just a slight miss on quarterly revenue or a delay in the Alani Nu integration, that multiple will violently contract and the stock price will crash.
let's ground this in some traditional modeling.
Right.
If we look at the intrinsic value using a standard discounted cash flow model, what is the actual fair price for the business based on the cash it produces?
If you look at educational DCF models, which align pretty closely with conservative firms like Morningstar, they peg the fair value of Celsius at exactly $32.50 a share.
And the stock is currently trading at $43.43.
Exactly. So it is trading at a significant premium to its mathematically calculated intrinsic value. The market is basically betting that those conservative DCF models are wrong and that the company will grow much faster than the spreadsheets predict.
Okay, so the financial reality shows us a remarkably powerful cash-generating engine, but attached to an incredibly, perhaps dangerously expensive stock. And that tension sets the stage perfectly for the second half of our analysis, Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Chapter 4. Market Sentiment.
So we know the cold hard math now, but the stock market isn't just math, it's a voting machine. What are the people actually saying and doing? Let's look at Wall Street's opinion versus the actual technical chart.
This is where the divergence gets really fascinating. The analysts, the people at the big banks who are paid to study this company full-time, are overwhelmingly bullish. The broad consensus rating is either a buy or a strong buy.
They see the top-line growth and they just want in.
They do. The average analyst price target is currently $66.22. That implies roughly a 50% upside from where the stock sits today, and some of the most optimistic targets go all the way up to $80 a share. They're looking at the Alani Nu integration, the Rockstar management deal, and they're saying this is going to be an unstoppable juggernaut.
But then you actually pull up the charts. You look at the technicals, the actual price action, and it tells a completely different story.
A very different story. The stock is currently trading below its 50-day moving average, which sits around $44 to $48. And it is also trading well below its 200-day moving average, which is up around $50 to $52. In pure technical analysis terms, despite the massive growth, the stock is in a confirmed downtrend.
Translating that for the non-traders listening, what does being in a downtrend actually mean for the psychology of the market?
It means the underlying momentum is negative. Every time the stock tries to rally on good news, institutional sellers step in at those moving averages and push the price back down to take profits or exit positions. So the analysts are shouting buy on TV, but the actual market participants moving the big money are leaning heavily towards sell.
It is the definition of a battleground stock.
Huh?
And that battle is perfectly reflected in the short interest data.
It really is. Right now, about 7.4% to 12.6% of the total available float is sold short.
That equates to what, 14 to 18 million shares?
Roughly, yes. That is a highly significant chunk of smart money, placing a direct bet that the stock price is going to collapse. They're looking at that 360 PE ratio and deciding gravity has to win eventually.
But with that many shares shorted, is there a setup for a short squeeze?
There absolutely is. The days to cover ratio is currently hovering around 3.5 to 4.4. What that means is, if Celsius comes out next quarter with a killer earnings report, say they blow revenue estimates out of the water, those short sellers might panic. They would have to rush into the open market to buy back the stock to cover their losing positions, which artificially drives the price up incredibly rapidly. That's your squeeze scenario.
The media narrative feels incredibly split, too, pulling investors in both directions.
Very split. On one hand, you have the financial press generating tons of positive buzz about the $300 million buyback. That looks great in a headline. But on the exact same day, you'll see negative pieces focusing on macro fears, the looming tariffs, consumer spending slowing down. It's labeled a battleground stock for a very good reason.
So who actually owns this thing while this battle is raging? Let's look at the cap table.
Chapter 5. Ownership structure.
I see here that the institutional dominance is massive.
It is heavily dominated by the big passive and active funds. 75.45% of the entire company is owned by institutional players. Vanguard holds about 7%. BlackRock holds roughly 6%.
Now, for an average retail investor listening, is that level of institutional ownership a good thing or a bad thing?
It's double-edged sword, really. On the positive side, it provides tremendous stability. These massive index funds don't day trade. They aren't flipping the stock every hour based on a tweet.
Right, they buy and hold.
Mostly, yes. But the risk is, if the core growth narrative ever fundamentally breaks, let's say they miss earnings expectations 2 quarters in a row, these active funds will completely abandon ship. And when an institution holding 6% of a company decides to exit en masse, it crushes the stock price.
I've heard it described as having an elephant in a canoe. It's perfectly stable, right up until the moment it decides to shift its weight, and then it flips everyone over into the water.
That is a perfect, terrifying analogy for high institutional ownership.
What about the insiders, the actual executives running the company? Are they buying stock or are they cashing out?
We have a slightly mixed signal here, but it's actually a very positive one if you dig into the details. We did see some high-profile selling recently from the DeSantis Trust.
And who is that?
That's a legacy holder. They are effectively the heirs of an early major investor in the company. They are selling via mechanical forward contracts, pre-planned sales. So it looks like a big insider sell-off on the surface, but it's really just standard estate management and diversification.
Okay, so legacy holder cashing out some chips isn't necessarily a signal of a lack of confidence in the future.
Exactly. It's just prudent wealth management. But the move you really want to pay attention to is from Eric Hansen. He's the president and chief operating officer. In late 2025, he stepped into the open market and bought roughly 4,500 shares.
Out of his own pocket.
Yes, that cost him over $200,000 of his own personal cash.
Buying $200,000 of stock when the valuation is already this high is a remarkably strong statement.
It aligns perfectly with the corporate buyback program. Operational management, the people actually looking at the daily sales data, are buying. Legacy heirs are cashing out. As an analyst, I always follow the operational management. That is by far the stronger signal. They believe the stock is going higher.
We also have to address the giant blue elephant in the room, the PepsiCo factor.
You absolutely cannot evaluate Celsius without evaluating Pepsi's grip on them. PepsiCo currently owns about an 11% equity stake in the company.
And they recently strengthened that grip at the board level, right?
Yes, in February 2026, two high-level Pepsi executives, Chryso Jacoby and John Short, officially joined the Celsius board of directors.
So they are literally sitting in the room where every major strategic decision is made.
They are in the inner sanctum. This undoubtedly cements the partnership. It guarantees that the distribution rails will remain smooth, but it also highlights the ultimate structural risk of the company. Celsius is now entirely structurally married to PepsiCo.
If that relationship ever soured, which sure seems highly unlikely right now, but things happen, Celsius would be in existential trouble.
It is the definition of a single point of failure. If Pepsi ever decided to walk away or prioritize a different brand, Celsius loses its entire distribution moat overnight.
Speaking of things that could go wrong, let's transition into the primary threats.
Chapter 6, Risk Assessment.
Let's start with a quick high-level summary. The SWOT highlights.
Sure. The biggest strength is undoubtedly that massive $523 million free cash flow engine. Their biggest weakness right now is the potential management distraction of integrating Alani Nu, paired with that optical drop in ROIC we discussed.
And their biggest opportunity.
Without a doubt, the international market. Right now, international sales make up only about 5.5% of their total revenue.
Wow, just 5.5%.
It's tiny. They are still an overwhelmingly domestic American brand. If they can successfully replicate their U.S. distribution and marketing playbook in Europe or Asia, that is a massive untapped greenfield opportunity.
But the threats? There are some genuinely scary macro threats on the horizon. Let's talk about the regulatory side first. The Sarah Caffeine Safety Act.
Yes, H.R. 2511. This was introduced in Congress back in March of 2025. It's important to just report the facts of the legislation here impartially. The proposed law mandates strict high caffeine warning labels on retail products and restaurant menus. It effectively aims to put a caution tape around the entire energy drink category.
But does that specifically hurt Celsius? Because their entire brand identity is built around being healthy, clean energy, a fitness partner. They aren't marketing to teenagers like some other brands.
It might not target them specifically, but it deeply hurts the entire category. Even if Celsius is objectively clean, if the federal government starts slapping bright red warning labels on all high caffeine products, it fundamentally stigmatizes the product in the eyes of the consumer.
It breaks the health halo.
Exactly. It could easily scare off those casual consumers, the 37% who are drinking it with a salad at lunch. If they see a warning label, they might just ask for an iced tea instead.
And then there is the immediate tangible threat, the one hitting the balance sheet right now, the tariffs.
The tariffs of 2025. This is arguably the most critical macro issue they face. On June 4th, 2025, sweeping trade policy kicked in, imposing massive 50% tariffs on imported steel and aluminum.
And Celsius comes almost exclusively in aluminum cans.
90% of their entire product line is packaged in aluminum cans.
So their primary raw material costs just skyrocketed overnight through no fault of their own.
It severely spiked what the industry calls the Midwest premium, the physical cost to get aluminum delivered to the manufacturing plant. And here's the brutal dilemma Celsius management is facing right now. We know they have great gross margins, around 50%, but with the cost of the physical can going up drastically, they only have two choices.
Right.
Choice A, they eat the added cost internally.
Which means those beautiful 50% margins shrink, profitability drops, and that sky-high PE ratio looks even worse.
Exactly. Or there's choice B. They raise the retail prices to pass the cost onto the consumer.
But if they raise prices in a market that's already saturated with aggressive competitors like Ghost and Prime,
Demand might drop. Consumers are incredibly price sensitive right now. People might abandon the brand and switch to a cheaper private label energy drink or just start brewing coffee at home again. This tariff situation is the single biggest immediate threat to their profitability. They're caught perfectly between a rock and a hard place.
and that leads perfectly into the broader economic sensitivity of the product.
Exactly right. At the end of the day, energy drinks are a discretionary purchase. Nobody fundamentally needs a $3 Celsius to survive. In a recessionary environment or a prolonged period of high inflation where rent and groceries are squeezing the middle class, consumers tend to trade down.
They cut the groceries.
Yes, they might buy the generic grocery store brand energy drink for $1.50 instead of the premium Celsius for $3, or they might buy the bulk powder instead of the convenient ready-to-drink cans.
So we have a company with incredible operational momentum, generating tons of cash, but it is sailing directly into a formidable storm of geopolitical tariffs, regulatory scrutiny, and a potentially weary consumer base.
That is the perfect summary of their current reality.
Let's bring this all home and try to weigh it out.
Chapter 7. Conclusion.
We started this deep dive asking one core question. Is Celsius a massive valuation bubble waiting to pop? Or is it a truly enduring legacy brand in the making? Let's summarize the bull case one more time.
The bull case is built entirely on their flawless execution. They executed the better-for-you pivot better than anyone else in beverage history. They have captured a dominant 20% market share in a highly lucrative category. The PepsiCo moat is practically impenetrable. A startup cannot easily replicate that massive distribution network. And critically, they have a cash machine generating over $500 million a year, which gives them the financial cushion to survive macro mistakes, integrate acquisitions, and buy back their own stock. Wall Street sees 50% upside because the underlying growth engine is undeniably real.
Okay. And the bear case, what is the counterargument?
The bear case is hyper-focused on valuation and macroeconomics. You are being asked to pay nearly 350 times earnings for a beverage company that requires flawless execution for the next decade to justify. Furthermore, the 50% aluminum tariffs are a margin killer that is completely out of management's control. Regulatory headwinds regarding caffeine are picking up speed in Washington, and the technical chart shows that institutional momentum has clearly flipped to the downside.
And sitting between those two extremes is the intrinsic reality.
Right. The math, the cold, hard, unemotional, discounted cash flow math says the fair value of this business today is $32.50.
But the current market price is $43.43.
Meaning the market is enthusiastically paying an $11 premium per share purely for the growth narrative.
So, synthesizing all of this data, from the Pepsi trucks to the SEC files, what is the final verdict on Celsius in 2026?
The verdict is that Celsius is no longer a speculative, scrappy startup. It has officially entered its maturing compounder phase. It is actively transitioning from being the agile insurgent in the industry to being the heavy incumbent.
It's defending the castle now, not storming it.
Exactly. But because of that transition, the margin of safety for a new investor, that buffer that value investors rely on, is virtually non-existent at this price point. Future success for the stock depends entirely on management pulling off two incredibly difficult tasks simultaneously.
For sure.
First, they have to navigate these brutal aluminum tariffs without destroying their gross margins or alienating their customers with price hikes. Second, they have to perfectly integrate the massive Alani Nu acquisition without losing focus on the core Celsius brand.
If they pull both of those off, the sky really is the limit. They could march right toward that $80 price target.
But if they stumble on either front, it is going to be a very rapid, very painful drop back down to that intrinsic value of $32.
Or lower if the institutions panic. Before we wrap up, I want to leave everyone listening with a final, slightly provocative thought to chew on.
Let's hear it.
We talked extensively about PepsiCo. They own 11% of the company. They have two of their own executives sitting on the Celsius board of directors. And Celsius is now running Pepsi's Rockstar brand for them in North America.
It is a very, very cozy corporate relationship.
Extremely cozy. So my question is the end game here really an independent future for Celsius Holdings? Or is Celsius simply grooming itself to be fully 100% acquired by PepsiCo? Is this whole arrangement just a long, slow-motion merger?
That is the billion-dollar question right there. If the Celsius stock price were to dip significantly due to these tariffs, Pepsi might just look at the board, look at the integration they already have, and decide to buy the whole entity outright and bring the captain in-house permanently.
It would make a lot of logistical sense, something for the shareholders to definitely mull over as they watch the charts.
Indeed it is. Keep a close eye on those board meetings.
That wraps up our deep dive on Celsius Holdings. It really is a fascinating collision of consumer wellness trends, massive logistical machinery, and global trade politics.
It's essentially the perfect case study for the modern consumer market.
This analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.